What's up, guys, and welcome to Wall Street Millennial. Today we're continuing our coverage of the Archegos capital liquidation story, which caused many stocks to freefall as the hedge fund's brokers unloaded tens of billions of dollars of shares at fire sale prices. According to new information, Archegos used massive amounts of leverage through a special type of swap contract and made massive positions in a number of stocks. For example, it was reported that they had economic ownership of up to 15% of Discovery Communications at the top. As Archegos unwound, its brokers were left holding the bag, with Nomura and Credit Suisse expecting billions of dollars in losses. However, Goldman Sachs and Morgan Stanley were able to unwind their shares of Archegos holdings with minimal losses. In this video, we're going to examine how Bill Hwang was able to take on so much leverage. We'll also go over how Goldman Sachs and Morgan Stanley were able to protect themselves from Archegos-related losses. On the morning of Tuesday, March 30th, many of the stocks that were reportedly being dumped onto the market for much of last week had been mounting a rebound. Discovery, one of the American media companies reportedly held by Archegos, was up nearly 10%, while Baidu, one of the Chinese internet companies held by Archegos, was up 7%. This came alongside reports by some news outlets that Nomura and/or Credit Suisse had continued their selling into the previous day. Archegos reportedly used total return swaps to achieve their leverage positions. In a total return swap, the hedge funds agreed to pay the broker a fixed interest rate over the course of a year. In return, the broker will go and buy some stocks of the hedge fund's choice. At the end of the year, the two parties settle the difference between the stock's return and the interest rate. For example, if the stock appreciates 15% and the interest rate is 5%, the broker pays the hedge fund the difference of 10%. Conversely, if the stock depreciates 15%, the hedge fund has to pay the broker 15% plus the 5% interest rate, for a total of 20%. The exact mechanics of how the swaps work isn't important. The bottom line is, they were paying a fixed rate to get leverage exposure to stocks. The end result is no different than buying stocks on margin, for example with Robinhood Gold. Most retail brokerages allow you to take on at most 2 times leverage, so if you have $1 of equity, you can buy $2 of stocks. But Bill Hwang was reportedly using 5 to 6 times leverage through his swap positions. By any standard, that seems like an insane leverage ratio, and it seems inconceivable that any brokerage would allow a client to take on so much risk. We know that Archegos used at least 4 brokers: Goldman Sachs, Morgan Stanley, Nomura, and Credit Suisse. The brokers at these banks don't necessarily talk to each other, so they don't know how much leverage Archegos is getting from other banks. If each broker thinks that they're the only one giving Archegos leverage, they may be willing to give him a 2-to-1 leverage ratio. So if Bill Hwang wanted 5 times leverage, he could potentially just go to 5 different brokers and max out the leverage ratio at each one. Normally, when an investor owns more than 10% stake in a company, they are required to publicly disclose them. But because Archegos was using swaps, they technically didn't own the actual shares, so they don't have to comply with those reporting requirements. So his brokers had no way of knowing how big his positions really were. This amounted to a massive failure of due diligence on the part of the brokers, which ended up costing them to the tune of billions of dollars. Here's a compliance expert explaining this very issue on CNBC.
In fact, there are some reports that the compliance department at Goldman Sachs actually got in touch with management and said, hey, you should not open this account due to the previous fraudulent activity that was discovered with the associated individual. So they could have made their case and got overridden by the business line managers. And unfortunately, that does happen all too often in our industry. But let's say, for example, they didn't do what they were supposed to do, and that is conduct the initial due diligence on the account during the account opening process, find out who the beneficial owners of the account are, and conduct their KYC, know your customer, and anti-money laundering reviews to determine if there was any previous nefarious activity by those individuals associated with the account. And if they had done that, they would have found that Mr. Hwang had previous SEC sanctions against him. And that should have been a huge red flag for the firm.
Right. So how should we be thinking about, or what do you say to those who are worried about the notion that that lure of revenue stream for the equities business at multiple banks was too seductive, and that in fact there is ongoing exposure to losses that we may not know about yet?
Right. So the business managers could have said, okay, we're willing to take this risk. We understand the risk, and we're going to take the account. And then in that case, what compliance could have done would be to put the account on a heightened surveillance program. which means that they are taking a look at the account and monitoring it frequently, more frequently than other accounts, and specifically looking for unusual trading activity, looking for high amounts of leverage or changes in types of securities being traded. So anything that could flag out as being unusual to that account, or particularly high margin, high volume of transaction activity, would flag out and then be looked at by the trade compliance staff.
In 2012, Bill Hwang was fined $44 million for insider trading in Chinese bank stocks. When a broker opens an account with a new hedge fund, they are supposed to do due diligence and make sure the hedge fund hasn't done anything shady in the past. This is called the Know Your Customer doctrine. In fact, Goldman Sachs actually refused to do business with Bill Hwang for a long time. Goldman Sachs' business managers wanted to open an account with Hwang for a long time, but every time they tried, the bank's compliance department denied the account because of Hwang's past insider trading scandal. But at some point in the last 2 years, the bank changed their mind and finally opened an account with Archegos. Archegos had grown very big, and the amount of fees Goldman could collect from the account was substantial. It is somewhat likely that Goldman's business managers saw the potential fees that they could make and got greedy. They could have overridden the compliance department and taken on the account despite the risks. This morning, some of the dynamics of what happened behind the scenes with Archegos' prime brokers was reported by CNBC. Nomura and Credit Suisse, two of the prime brokers used by Archegos, announced that they are facing highly significant losses relating to the liquidation of Archegos. Their stocks were down more than 10% each on that day. It was reported by CNBC that they might have to take up to $2 billion of losses as a result of the uncoordinated unwinding of Archegos' assets. Meanwhile, American brokers Goldman Sachs and Morgan Stanley also warned of losses, but they said that their losses would be immaterial to their bottom lines. Goldman Sachs and Morgan Stanley are two of the 3 biggest prime brokers in the world, along with JP Morgan. Credit Suisse is also a major prime broker, but Nomura is comparatively small. Goldman and Morgan Stanley stocks were both down much less than Nomura and Credit Suisse. According to CNBC, Goldman Sachs and Morgan Stanley were able to avoid the magnitude of losses incurred by Nomura and Credit Suisse. Apparently, last week, 5 of Archegos' prime brokers met to discuss how to offload Archegos' balance sheet in a coordinated manner. They wanted to avoid a violent and volatile fire sale of the several stocks that Archegos held. However, apparently, Goldman Sachs quickly began dumping massive blocks of shares on its own clients, and Morgan Stanley sold $15 billion of shares over the course of a few days. It took a while for the markets to understand what was going on, so they were able to do this without taking on too much losses. On the flip side, both Nomura and Credit Suisse said that as of Monday, March 29th, they were still unwinding positions. By that time, the stocks had fallen in price significantly, and the firms took huge losses on their sales. Nomura estimated that the losses they incurred up through Friday, March 26th would be as high as $2 billion, and we now know that they did not even finish offloading all of their stock at that time. Nomura and Credit Suisse are significantly smaller prime brokerages than Goldman Sachs and Morgan Stanley, especially in the US. This might have encouraged them to take riskier clients, including Bill Hwang, because of the high commission fees they could charge. However, it also made it more risky for them, because in the event that they would need to offload large positions, their smaller-sized trading operations would have less ability to find clients that would be interested in buying large blocks. Goldman, in contrast, has a very large trading operation, which helped them offload more than $10 billion of shares in Baidu, Tencent Music, Viacom, and Discovery, according to CNBC. Alright guys, that wraps it up for this video. Before you go, make sure to check out our second channel, WSM Research, where we post DD videos on high-growth tech stocks. If you like this content, make sure to hit that like button for the YouTube algorithm, and subscribe so you don't miss future updates. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.